Welcome back to Investing Talk Podcast.
Today we're looking at Multisensor AI holdings. The big question is it a good time to buy now?
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. Multisensor AI Holdings is a genuinely intriguing company. They've really positioned themselves right in the sweet spot of several converging tech megatrends.
Yeah, they seem like a pure play on AI, right? With this AI-powered multi-sensing platform.
That's it. It's an AI-powered multi-sensing platform.
Okay, that sounds a bit dense. But maybe unpack that for you listening. When we talk about this kind of platform, integrating edge and cloud analytics, what does that actually mean?
Right. So think of it like this. It's not just a camera looking at one thing. It pulls data from lots of different sources. Could be thermal, sound, vibration, you name it. And it processes that information in two places. Some processing happens right there. Locally, that's the edge part for immediate alerts. And then the bigger picture stuff, the heavy data crunching and pattern finding, that happens centrally in the cloud.
Gotcha. So it's like having eyes and ears everywhere.
Yeah.
With a brain both on-site and back at HQ.
Precisely. And that capability, that flexibility, is what lets them tackle these huge, diverse markets all at once. We're not just talking about one little niche here.
Right.
Their platform can handle complex security setups, big industrial automation projects in manufacturing or logistics, and even very specific defense applications.
So that ability to cross boundaries is what makes their potential market so enormous.
Exactly. And what's really fascinating, something the sources emphasize, is their strategic pivot. They're actively shifting their business model.
How so?
They're moving towards being hardware agnostic.
Ah, okay.
Yeah.
That's like a smart move.
It really is. It gets around the whole capital expenditure problem for their customers. Instead of making clients buy their specific sensors or boxes, they're focusing on selling the intelligence, the software, the service layer that can run on hardware the client already has or on third-party stuff.
And they're pushing this through distributor partnerships.
Yes, exactly. Major partnerships with distributors.
That totally changes the financial picture, doesn't it?
Yeah.
Moving away from just selling boxes one time.
Right.
To building up that steady stream of recurring software and service revenue. That's kind of the holy grail for software-like companies, isn't it?
It absolutely is. Recurring revenue means better long-term margins, much more predictable income.
Which investors love because they can model it out reliably.
Exactly. The market rewards subscription models much more generously than one-off hardware sales. This shift, it signals maturity. If they pull it off, it justifies a much higher valuation multiple down the line.
Okay, that strategy sounds great on paper.
Yeah.
But is the market actually buying into it yet? How do the immediate numbers look?
Well, let's look at the fundamentals because they are undeniably bullish right now. Trailing 12 months revenue came in at $7.40 million.
Okay, $7.4 million. And how does that compare?
That's the key part. It represents a 36.32% increase year over year.
Wow, over 36%.
Yeah. In a sector where, adoption cycles can be slow, sustaining that kind of growth is really robust. It suggests the market is starting to adopt their AI solution. They're growing fast enough to grab real market share.
And that growth just got a serious boost, right?
Yeah.
They recently closed a big direct offering.
Huge. A massive $14.4 million registered direct offering completed just a few days ago, November 5th.
For a company this size, that's a major vote of confidence.
It's more than confidence. It buys them runway. That capital, they've specifically said it's for near-term growth initiatives.
So scaling up deployments, maybe faster software development, chasing those bigger deals.
All of the above. They basically don't have to worry about immediate cash burn for the next, say, 12 to 18 months. It de-risks their operational plans significantly.
And Wall Street seems convinced, too. We saw analyst ratings mentioned.
Yeah, 2 independent analysts reaffirmed a strong buy rating. These aren't small shops either.
Okay, strong buy. What about price targets?
That's where it gets eye-catching. The consensus 12-month target is sitting in a range of $2.75 to $3.
$2.75 to $3. Wait, depending on today's price, that's like over 75% potential upside?
More than 75% potential upside, yeah. Which tells you analysts aren't just looking at current revenue.
Right, they must be pricing in that strategic shift, succeeding, the recurring revenue kicking in.
And the overall market potential of their AI tech.
Okay, but 75% upside is huge. We know they're still losing money overall, right? Isn't that target pretty speculative at this point? What's the immediate hurdle they need to clear?
That's the perfect question. It really boils down to execution and upcoming catalysts. The market needs proof points, proof that the cash is translating into actual contract wins.
And it looks like the next few months are packed with potential triggers for the stock.
Absolutely. If you're thinking about trading around news, you need these dates marked down. The immediate acid test is just around the corner. The Q3 2025 earnings report.
When is that?
Scheduled for November 13th. And expectations are high. Analysts are looking for continued acceleration, specifically hoping for over 30% year-over-year revenue growth.
So this isn't just any earnings report. It's the first big update after that huge capital raise.
Exactly. Did they put that money to work efficiently straight away? Did they start scaling up? That's what the market wants to see.
Okay, so mid-November is key. What about later in the year?
December has a couple of interesting drivers. Around December 18th, you've got the standard ETF rebalancing cycle.
Why does it matter for a stock like this?
Well, for smaller, high-growth stocks, ETF rebalancing can create sort of automatic buying pressure. Certain funds have to buy shares if the stock meets their index rules. Regardless of the price at that moment, it's passive flow.
Interesting. Passive flows. Okay. And then later in December?
Around December 23rd, we're expecting a holiday demand update.
Like a check on their smart security sales during a busy season.
Precisely. It gives us a timely peek into whether those distribution partnerships are actually moving product, especially during a peak demand period.
Okay. And then looking into early next year.
There's another critical checkpoint. January 12th, 2026. That's when the institutional holdings disclosures are due.
So we find out if the big players, the hedge funds and mutual funds, were buying or selling during that November period with the offering and price swings.
Exactly. If you see large funds were loading up, that confirms some serious conviction from the smart money.
Got it. So beyond those scheduled dates, there's also just general market buzz, right? Especially with small cap AI stocks. Rumors can really move the needle.
Oh, absolutely. It's the stuff that fuels the volatility. The most persistent rumors seem to be around a major strategic partnership.
Like who?
Speculation points towards either a large industrial automation firm looking to integrate Multisensor AI's platform into factory systems, or maybe a significant defense contractor needing their, advanced sensor fusion capabilities.
Either of those would be huge validation.
Massive. It would prove their tech in a huge established market vertical.
And what about those licensing deals you mentioned earlier, linked to the recurring revenue push?
Yeah, there's talk of potentially substantial AI platform licensing deals. If they could lock in a big master license agreement with a major client, generating consistent, repeatable software fees.
That would immediately help their margins and start closing that net loss gap.
Definitely shores up the visibility. And then, of course, you always get those periodic whispers about a potential buyout.
Right. Small company, cutting-edge AI.
Larger tech firms that maybe lack that specific sensor fusion tech might start sniffing around for an acquisition.
Okay, so adding all that up, technically the stock chart must look like a roller coaster.
It absolutely does. The 52-week range tells the story. $0.46 on the low end, all the way up to $3.33. That screams high risk, high reward.
But that volatility also gives us some clear levels to watch.
It does. The technical setup right now is pretty interesting. We have clear short-term support right around $1.35.
And that $1.35 level isn't just random, is it? That was the price of the recent offering.
Exactly. It creates a strong psychological floor, and likely an institutional one, too. The big investors who bought in at $1.35 probably don't want to see it dip much below that.
So support at $1.35. Where's the resistance, the ceiling?
The resistance zone lines up almost perfectly with those analyst targets we mentioned, somewhere between $2.75 and $3.
Okay.
If the price breaks through that upper level, especially on good news and high volume, that could signal a major multi-year breakout.
All right, we've laid out the bull case pretty well, the growth, the cash, the catalysts, the rumors. But we need balance. What are the biggest risks here? Where should you be cautious?
The number one risk, despite that strong revenue growth, remains the sustained net loss. We're talking $21.50 million lost over the trailing 12 months. Now, yes, that loss is narrowing. It's down about 3.5% year over year, but it's still a big number. It really highlights the execution risk.
They're burning cash to grow.
They are. And if those big partnerships don't materialize reasonably quickly, they might have to go back to the market for more cash sooner than anyone wants.
And speaking of raising cash, that recent $14.4 million offering, while great for liquidity, it also means more shares outstanding, right?
That's the textbook definition of dilution. For existing shareholders, your piece of the pie gets smaller.
So unless the operational gains, the profits, grow fast enough to offset that.
It puts pressure on future earnings per share. You need really rapid profit growth to justify those extra shares floating around.
Makes sense. Any other major risks?
Just the inherent nature of the company's size. It's got a low market cap, around $54 million currently. That's classic small cap risk. Which means you're exposed to much higher volatility and potentially lower liquidity compared to a big established company.
So the stock price can swing wildly on little news.
Exactly. When sentiment shifts in the sector, or even just the broader market, a small stock like this can get hit hard. You have to be comfortable with potential sharp drops, maybe 10%, 20%, just because the trading volume might be thin.
Okay, so let's try to synthesize all this for you. We've got the accelerating growth, the big cash injection, strong analyst confidence pointing to significant upside, plus this pipeline of near-term catalysts. What's the overall takeaway?
Well, the overall investment thesis, based on our read of the sources, lands pretty firmly on bullish, but in that high-risk, high-growth category, we'd probably peg it around an 8.5 out of 10 for that specific niche.
Because the fundamentals are strong, they have the cash to execute.
Right. And institutional confidence seems high, particularly around that pivot to recurring software revenue, which is key for the long term. Momentum seems to be building.
So it looks like a stock that could appeal to different types of investors.
I think so. It's definitely positioned for trading around news events like that upcoming Q3 earnings report. So short-term traders might see opportunities, but it also fits that long-term narrative. If you believe in the multi-year growth story for AI, the Internet of Things, industrial automation, this company sits right at that intersection. So longer-term holders might see value too.
It really is one of those high-growth, high-risk plays where everything hinges on execution now.
Absolutely. And given that strong cash position they have now and the clear need to ramp up commercially, the key thing to watch for Multisensor AI holdings won't just be how much revenue they grow in Q3. The really critical factor, I think, is how effectively they deploy that $14.4 million over the next 6 months or so. Can they use it to actually lock down some of those potentially lucrative partnerships everyone's whispering about for the first half of 2026? The money's there. Now they have to prove they can turn that potential into real sustainable profit.